welcome to the special Coffee on the Couch edition of Business Insights. As always, I'm your host, James Riley. We'll be discussing the recent controversial takeover between oil giants Halliburton and Baker Hughes. Halliburton is proposing a $34.6 billion move for its fierce competitor, a move which is predicted to see a number of strategic operational benefits, as well as costs, from the perspectives of both companies involved. However, the ACCC is currently investigating the public concerns of anti-competitive behaviour. Today we will be talking to Lachlan, an official representative of Halliburton, as well as George Keramidas, a spokesman for the ACCC. First, thank you for taking the time to be with us today, Lachlan. My first question today for you would be, what are the reasons for Halliburton and Baker Hughes wanting this takeover to go ahead? And what would be the benefits of such a deal?
Thank you for having me on your show today, James. To answer your question, I'd refer to what Martin Craighead, the CEO of Baker Hughes, has recently said. Now, this takeover brings our stockholders a significant premium and the opportunity to own a meaningful share in a larger, more competitive global company. We envision that this combined company would be capable of achieving opportunities that neither company would have realised as well or as quickly on its own, all while creating exciting new opportunities for its employees. From our perspective at Halliburton, the takeover would leverage complementary strengths to create a company with unsurpassed breadth and depth of products and services. While there are at least 7 major services where there is an overlap between the two companies, the deal would fill gaps in 2 major product lines in Halliburton's current portfolio, being product chemicals and pumps that boost output from wells. The resulting company will provide a comprehensive suite of products and services to customers in virtually every oil and natural gas producing market in the world.
So, continuing with your point, would there be an opportunity for synergy to be created through the proposed takeover?
Absolutely, James. The acquisition would generate significant opportunities for synergies. The combination will provide substantial efficiencies of scale and geographic scope, particularly in the Eastern Hemisphere. Once fully integrated, Halliburton expects the combination will yield annual cost synergies of nearly $2 billion, where these synergies are expected to come primarily from operational improvements.
Now, I know your time is limited today, Lachlan, so I'll move you to my next key question, being that for a takeover a company the size of Baker Hughes, the costs are obviously enormous. Could you give us a little more detail about these costs and what their impact will be?
Absolutely. The cash and stock deal was valued at $34.6 billion US when it was announced at the end of 2014. However, since then, shares of both companies have dropped more than 30%, and with the worldwide decrease in oil prices, by the February the 1st of this year, the price tag for the merger had fallen from $34.6 billion to just $23.7 billion. During negotiations, Halliburton had also agreed to divest businesses that generate up to $7.5 billion US in revenues, or possibly even more, for the deal to receive regulatory approval. Just recently, private equity firm Carlyle Group has been in serious talks to buy a package of oil field service businesses from Halliburton and Baker Hughes. That could be valued at more than $7 billion to ensure that the takeover will receive this regulatory approval.
To interrupt you there, Lachlan.
Of course.
But if the takeover weren't to receive regulatory approval, and should the deal not go ahead, I hear there is a breakup fee. Would you care to expand on this?
As you said, James, there is a breakup fee. If the deal does happen to be dropped, Halliburton has agreed to pay $3.5 billion to Baker Hughes, which represents over 15% of the total deal as of February 2016. So, of course, ensuring the acquisition goes ahead is of great importance to the company.
So if the deal doesn't go ahead, what will be the effect of this breakup fee on the companies?
The breakup fee won't sink Halliburton, that is for sure. Soon after the merger was announced, Halliburton raised $7.5 billion through a debt offering to fund the purchase. We at Halliburton could use those funds to eat the termination fee, and the company would still be left in a relatively strong position of having approximately $6.6 billion in debt. In addition, with the deal off the table, Halliburton would be free to shed the extra employees and the logistical assets it had been holding in anticipation of becoming this much larger company, where these savings could total as much as $350 million per year. Meanwhile, for Baker Hughes, the $3.5 billion fee would provide a short-term boost, as the company could use the money to refurbish its equipment, much of which needs service after the recent downturn curbed capital spending in the company.
So Lachlan, you've given us an overview of the costs relating to takeover. What will be the resulting impact on the financial statements of the combined companies should the acquisition go ahead?
So James, using 2014 figures, the acquisition would result in a combined revenues of $57.4 billion US, which is more than the company's largest competitor, Schlumberger, whose revenue totaled just $48.6 billion. However, the combined market capitalization would still be less than Schlumberger's $122.6 billion US.
Thanks, Lachlan. So we've just seen the perspective of one of the companies involved in this deal. Lachlan touched on a number of advantages of this deal, most significantly including the opportunities for investors, but also opportunity for the company itself to be a more competitive global company. I'd like to welcome a spokesman from the ACCC, George Karamidas. George, can you tell us a bit about the proposed acquisition?
Hi James. Well, basically the ACCC's main goal is to ensure any mergers or acquisitions do not have any anti-competitive effects, meaning that when a business acquires another business, it doesn't substantially lower the competition within the market. This may include things like the barriers for new businesses to enter the market, how much power one business may have in the market compared to the rest, and the likelihood of a removal of a vigorous or effective competitor.
Are there any concerns regarding the acquisition of Baker Hughes by Halliburton?
The initial issue that we have found with this acquisition deal instantly was that based on the total annual revenues, Halliburton and Baker Hughes are currently the second and third largest providers both globally and in Australia of oilfield services, which is behind Schlumberger as the largest provider. So these three firms were described as the big three within the market of oilfield products. And the problem arises as you're merging two of the big three, being Halliburton and Baker Hughes, to essentially create the big two, which is quite an alarming sign, and we are currently looking at information provided by both businesses to evaluate whether or not this is an anti-competitive acquisition.
The oil market raises concerns due to its limited but essential nature. What are your concerns about this?
So one of the main considerations we make is the substitutes a certain resource or product has in the market. Although there is extensive research in the area of substitutes, currently there are no entirely viable alternatives to the use of oil. This may change in the coming years with certain technological advances, but at the moment we are highly dependent on oil, so Halliburton taking such control over the market could be quite problematic.
Very interesting. I'm assuming those hit hardest by this are the smaller oil businesses.
Yeah, that's right, James. One of the most important features that we are specifically looking into is that oilfield services that have major global suppliers usually have a large competitive advantage to smaller competitors and potential entrants. So we're making sure that this acquisition will not detriment the future of any smaller and current existing oilfield service businesses, and will also not be impossible for new businesses to enter the market and have the opportunity to compete against other businesses.
If I may, George, respectfully, I would like to point out a $7.5 billion package of assets that we'll be selling to competitors to ensure that there will be in fact enough competition in the market. This aims to maintain a balance of competition through continued strengthening of competitors.
That's a good initiative, Lachlan, but the issue that the ACCC has is that the falling oil prices are forcing smaller drilling companies to slash their investment budgets, meaning that there are a few rival companies out there that are looking to expand and compete with the likes of Halliburton and Schlumberger. As I mentioned earlier, the barriers to entry are quite high, and as the oil price continues to drop, the barriers will continue to increase and lessen the competition in the market.
Sorry guys, very interesting debate, but as we are running out of time, I'll have to stop you there. Lachlan, official representative of Halliburton, and George, spokesman for the ACCC, thanks for joining us. It's been an absolute pleasure. So we've seen both sides of the argument as to whether this deal should go ahead. Make sure to keep tuning in to find out the ACCC's decision in assessing the potential anti-competitive behaviour of Halliburton. Thanks for watching guys, and I'll catch you next week.